So as we enter 2020, with a strong and a weak day to start the year, we're going to discuss those catalysts confronting markets in the year ahead. So January 2nd picked up right where last year left off with strong markets, not unlike 2018 to 19, where the weakness of December carried over into that first day. The rest of 2019 obviously proved to be strong in the equity markets. Still to see what lies ahead for us here in 2020. Of course, Friday's news came with the airstrike in Iran, killing one of Iran's top military leaders while he was in Iraq. And that's dampened the market. So we had a quick 1-2 high-low here to start the year. What lies ahead? So if we look at the geopolitics first and three of the likely scenarios. So one is that Iran follows through on their new threat, which is to retaliate. And if they did that in a strong way, which we think is doubtful, that would certainly roil markets. Given the protests that are happening currently within Iran, the sanctions which have severely weakened them, not to mention their severe disadvantage vis-a-vis the U.S. military, not just my own take, but those of a lot of others I respect. I think that's probably the least likely scenario, but it would certainly be the most damaging to market. So while Friday bounced back decently, the real test will be what this Iranian response is. The second is that they could do nothing. We think that's, again, just like the first scenario, probably highly unlikely that they wouldn't retaliate in some form or another. The third option, and again, this is where we get into the shades of the gray, is that they might attack some type of an oil platform as they've done in the past, or attack civilians as they've done in the past. That would probably lead to a lesser reaction, certainly less than a full-blown war. Secretary of State Mike Pompeo came out Friday morning saying the U.S. does not want a full-blown war with Iran. And so again, it's going to come down to this Iranian response of whether we go to option number one, which would be an unfortunate war-type scenario in the region, or option number three, which is more of a ceremonial response, not to make light of undoubtedly the damage that would happen, or symbolic, I should say, but not result in a full-blown war. The second big issue the market's got to grapple with is this tug of war between weakening manufacturing data from around the world and a still strong U.S. consumer and decent service sector data in a number of countries. The deceleration continues here, not only in the U.S., but also overseas in China and the Eurozone, the three biggest economic blocks, of course, in the country. And here in the U.S., December's data fell to 47.2. 5 straight months of decline, now 127-month low. The important leading indicator, new orders, fell to a post-2008 low of just 46.8. So again, a lot of that optimism coming out of October that lifted markets over the last 2 months and was hoped to carry over into a rebound in the actual economic data as companies had more clarity and began to invest, at least at this point, is still not playing out. You couple that with the fact that inflation is accelerating, which will only be exacerbated by today's oil move after the attacks. You've got projected 95% of the top 20 economies will be experiencing acceleration in inflation in Q1. That type of stagflation, i.e. rising inflation, stagnant to lowering growth, can be a very difficult time for markets, coupled with the third point, which is how we unwind this sentiment. CNN's Fear and Greed Index that we've been talking about for a little while hit an all-time high on Thursday, the first trading day of the year, at 97%. Now, it can certainly carry forward for a period of time, but when you look at the still unresolved Phase 1 deal, which the U.S. says is being signed January 15th, China hasn't committed to, manufacturing data that seems to be bucking that trend, coupled with quite the run in the U.S. markets over the last few months and extreme bullishness within investor sentiment, people should at least proceed with caution. We'll wrap up this data deluge with the one last point, which is U.S. housing might be our savior. So the very thing that took us into the abyss in 2008, even more than perhaps the U.S. consumer, seems to be buoying up the U.S. economy and very well could be the thing that keeps it from entering into a recession. It was really weak at the end of 2018 as people saw interest rates moving higher, but as the Fed cut 3 times in 2019, it's bottomed out and begun its ascent. Lumber prices have solidified after last spring and rising vis-a-vis gold, which some analysts that we respect look to as kind of a risk-on versus risk-off indicator. And so again, if that continues to play out, it should be enough of a fundamental floor to keep markets from weakening too much. So pulling this all together, what do I do with this information, Tim? Well, you don't run for the hills, but you don't go all in and try to buy Apple necessarily at $300 a share with everything you have either. Again, take these opportunities to reevaluate where you're at from a risk profile here as we begin the new year, especially after the market might enter into a little bit of a risk-off phase for a period of time. Reevaluate your plan. Again, how's the math looking? And pull that all together to understand what your game plan is going to be for you, regardless of what the markets bring in 2020. Key is being patient. It's very tough to do, but no investment should ever have to feel rushed. And that's the key thing I want to lead you with. Take all these headlines as something to spur you into some self-reflection. We're certainly here to help, have some great tools that we can work with you to do that with, but don't get too caught up in wasting time within those headlines. With that, Happy New Year. Looking forward very much to the year ahead with you.